Hello everyone, welcome to another episode of Returns Weekly. It has been quite an eventful week, and so I'm expecting this episode to be quite a lengthy one. So let's get straight into it. I will share my screen. Right, so quite a bit of news from across the portfolio to discuss, but the really large thing, the really large item, and I want to discuss that actually has its entirely own article, is an update on tinyBuild. So let's just dive straight into that, and then we can go back and look over the rest of the news for the portfolio from there. So let's begin. Things have taken an unfortunate turn for the worse at tinyBuild. As outlined in their latest trading update, revenues were significantly lower in Q4 than expected due to a number of factors. First among these was the delay in signing certain large contracts, which as of 6th of December remained under negotiation. Several releases have also been delayed, including the highly anticipated Broken Roads, previously expected to make a considerable contribution to Q4 revenue. This was further compounded by weaker than usual sales across the portfolio that has driven management's full-year revenue expectation down to $40 to $50 million. And I think it was something like, I think last year was $65 million, something, so quite a big drop. And with the upper end being dependent on the aforementioned large contracts being signed, so you can kind of see how large those contracts are. We're talking sort of $5+ million in total for the largest ones combined, I think. Entwined within this was the legal dispute with Steve Escalante, the founder of Versus Evil, who has unfortunately been running the studio into the ground as general manager since the acquisition. It seems that he has been able to extract a further $3 million from tinyBuild for his exemplary service in this time. This payment settles one of the two claims against the company. The second, related to the contingent consideration cancelled as a result of the studio's underperformance, is being settled with a payment of $500,000. It's disappointing that a payment is being made at all, but from the conversation I've had with management, it seems they were forced into a quick settlement due to the dramatic decline in revenue and inability to take any strategic action with Versus Evil while the legal claims were unresolved and Steve Escalante was at the helm. He will be departing presently. In short, the company couldn't afford a lengthy legal dispute, however likely they were to win, and it had consequences beyond the legal fees, not least 3 delayed games at Versus Evil. Another consequence of the revenue shortfall has been the acceleration of the company's cost reduction plan, which has unfortunately resulted in significant redundancies and the closure of 2 studios. At a company level, there's going to be an initial impact from one-off severance charges and further asset impairments, but the actions taken thus far are expected to result in a $5 to $10 million per annum reduction in cash outflow. I think it was something like, it was going to be broadly, and I think it was like $35 million was spent on software development expenses last year, and it was going to be fairly similar this year. So presumably that's where a lot of the savings is going to come from, with these different projects that have been cancelled and studios that have been closed. I imagine there's also going to be, I don't know whether all of that there'll be additional stuff that will come off, just the general operational expenses rather than stuff that was been capitalized into development projects, so as head office stuff or whatever. So it might not all come off that $35 million figure, but I certainly expect that to come in quite a bit lower next year than had been, or quite a bit lower next year than this year, maybe, let's say that. The company's cash balance at the end of November was $5.7 million and is expected to decline further by the end of the year, leaving the balance well below the $10 to $20 million previously guided. And that was back in September that it was guided to be that level. So a lot has gone wrong in the last couple of months. If the previously mentioned large contracts are not signed, the company is going to run out of cash by the end of January. A $10 million equity raise has therefore been proposed, subject to shareholder approval. Alex Nishi-Porshik, tinyBuild's CEO and founder, has expressed his willingness to underwrite this equity raise, but were this to result in him increasing his ownership percentage, it would also be subject to a shareholder vote. And I believe, haven't had the same vote held at the AGM and didn't pass, it would require 70% of shareholders to vote. And obviously he's going to lend 37.8%, I believe. But the rest has to come from the remaining minority shareholders out there. So myself and a number of other shareholders wrote a letter to management, which was sent the day following the announcement, the 6th of December. 2 of our number then had a meeting with management on the 7th. In the letter, we raised our concerns about excessive dilution of existing shareholders unwilling or unable to participate in the equity raise, and presented some potential alternatives and safeguards. The first alternative was asset sales. Apparently, the M&A market is surprisingly active right now, despite sales having deteriorated across the industry. Unfortunately, given the company's current position of weakness, they are receiving very low offers, making asset sales an unattractive option at this time. So in the call with management, they did actually say they've been receiving offers pretty well on a daily basis, but with incredibly low ball offers for I don't know whether that's for, I'm presuming some individual assets in there, IP and so on, or maybe larger chunks of the business. But yeah, obviously the voltages are circling and trying to extract as cheaper price as they can. We also discussed the use of other securities like preferred equity or convertible debt, but they weren't too keen on these options because of the perceived higher costs and conflicting incentives for Alex as both shareholder and creditor. When it comes to a common equity raise, there are 2 main ways they can do it. They can use the market price at closing the previous day and apply a discount, or they can set a fixed price independent of the market price to cap the dilution. We have obviously pushed for the second option as it limits the extent of the dilution to a hopefully reasonable level. If instead the first option were chosen, you'd likely be looking at greater than 50% reduction in the value of your shares, as the price has fallen dramatically since the announcement. So I think the price when I was looking at this was like 3 pence a share or something like that. And at that price, you'd be more than halving the value of everyone's shareholding. So I think it'd be like you'd end up with about 40 or 42% that your shareholding only being worth something like 40 or 42% of what it was before. So what would be a reasonable price? If the price was set at 15 cents, which equates to 12 pence at the current exchange rate, 66.6 recurring million new shares would need to be issued to raise the required $10 million, which would result in the shares losing just under 25% of their current value, based on 203 million shares outstanding pre-issuance. So what I'm saying is that your shares would then be worth 75% of what they were before. So yeah, it's not a great outcome, but that kind of level would be bearable. It means, as long as you had more than a 25% sort of margin in there on what you thought the underlying value of the business was, or what it could be in a few years, that you've still got the prospect of capturing most of the upside, should the company go on to perform well over the next couple of years. In a scenario where Alex was the only participant at this price, so 15 cents or 0.15 US dollars, equating to 12 pence or 0.12 pounds, and permitted to go beyond his current ownership percentage, so effectively both votes passed, he would end up owning 53% of the shares outstanding, making him the controlling shareholder. Now, it seems, unless they get some external shareholder to come in, but it doesn't seem like many are interested at this price, given how low the company's market cap is. It's not really even a viable option for certain funds and things like that to come in. But were it, so it seems unlikely that an external investor is going to come in, and at 12 pence a share or whatever, which is higher than the current share price, and given all we've said about, trust perhaps being broken and other things along those lines, it seems pretty unlikely that most existing shareholders are going to want to participate in such an offering. So you would expect that Alex is going to end up having to pay most of the $10 million, which would make him the controlling shareholder, because he would then have 53% of the new total number of shares outstanding. Crucially, whatever price is chosen, it needs to be palatable enough to pass the vote. If the dilution is going to be high, shareholders may prefer to take their chances with bankruptcy, given that the company's equity value is far higher than the current market capitalization. So, I think at the last update, equity was something like $80 million. And, even if you cut that in half, or even more than half, it's still going, if you're talking about sort of greater than 50% dilution or something of your shares, then yeah, it starts, whatever, depending on the price you bought the shares at, you're starting to look like getting a better result from the company going into administration and the assets being sold off. So this is why, if they want a shareholder vote to pass, they really need to make it a palatable deal to shareholders. I'm confident Alex won't let the company fail, but less so that he's going to avoid destroying minority shareholders' capital through excessive dilution. In all honesty, I've already invested a very significant portion of my portfolio into the company, having been assured that this kind of equity raise was not going to be necessary. It's very hard for me to consider providing more capital on this basis. And to be honest, I would have to sell some other holdings in order to do that. So further concentrating myself in this company and selling other companies, which I would like to hold still. So it's I'm already overexposed, and given, and I'm kind of on the borderline here in terms of trust, but I can imagine a lot of people looking from the outside here they've been told, oh, there's going to be $10 to $20 million at the end of the year. There's going to be there's a credit facility in place that could potentially be used as in a last resort, where there's pretty much no chance in any of their worst case downside scenarios that they're going to need to do anything like an equity raise. It's not even like in the picture. They don't expect any payment for the legal claims. Yeah, and they expect to be effectively able to maintain their cash balance next year. We'll see. That's still in the future, but all those other things are things that were statements that have now proven to be false. So it's quite a big ask to ask people to put up more money at this stage, given that everything else that's been said on the assurance that things are going to be fine in the future, given everything else that's been said and has not proven to come true. So yeah, and like I say, I'm already in a concentrated position on a cost basis into this company. Obviously that holding is now worth a tiny fraction of my initial investment, but in terms of market prices, but it still is something that I would like to hold long term. It's really going to depend on what they do here with this equity raise. If it's minimally dilutive, if they do it or if they consider some other options, the ones we've presented, like a convertible preference share that has a reasonable coupon attached to it, a reasonable dividend attached to it, that then has a conversion option in a few years' time, when the company is likely to be in much better shape and the price is high enough based on the current share price that the dilution would be less, would able to be less than if it was just to be a full common equity issuance now, or if the price is set at a level in a fixed way that means the dilution is capped. I was saying the 12 pence a share is still not pleasant to lose 25% of the value of your shares, but it's a bearable amount, and ideally it would be even less than that. But maybe people, in aggregate, there's the people who voted not to allow Alex to play shares before, so maybe him being in a position where if he was to participate fully would be able to get a majority, wouldn't be enough, wouldn't be acceptable. So maybe people still want him to have less than 50%. So maybe it would end up being set at an even higher price in order to make sure that even if he participated fully, he wouldn't own 50%. Who knows? But yeah, I think any price higher than 12 pence a share would be reasonable, and the higher the better. And either way, I don't see, even at a dirt cheap price, I don't see many existing shareholders participating beyond Alex. So he'd effectively just destroying all of their capital, and handing it over instead to, if it wasn't entirely him participating, then it would be handing it over to new external shareholders and basically giving the middle finger to the existing shareholder base. So yeah, if we don't have any of these dilutive things happen, if they do take action to limit the extent of the dilution, or they look at other options, or maybe they're able to sell some assets. Now with the restructuring versus evil, maybe there could be a quick sale there. Maybe there's IP that could be sold and what have you. So I know the fact that there is now potentially an equity raise as a fallback might mean that it strengthens their position in any negotiations for asset sales. Then they'd be able to sell something that would either remove the need to raise equity or would reduce the amount that was needed to be raised. It could be 5 million instead of 10, for instance, whatever scenario you want to put out there. But if there's a way they can reduce the value destruction, then yes, that would be good to see. Obviously, is something I'm looking for, and will determine what the vote I give as well, of course, being a shareholder. But the other aspect here is that, yeah, if management does show me that they care about the minority shareholders at this stage, then I don't see any reason why I wouldn't want to hold the company in the long term. I do still think it has bright prospects. We have some phenomenal titles in the pipeline. The cost base, while unfortunate, and it has led to there's been a bit of a cash crunch, perhaps because some of these cost cuttings happened a bit later than they had perhaps hoped for better revenues, and so a lot of the cost cutting happened later than the original timetable for it. They said as much in the trading update that it was accelerated, but obviously things have happened too fast and left them in a bit of a liquidity squeeze here. So if instead, but yeah, now that those cutting measures have been made, the company is in a better position going forward, and it means that there's greater operational leverage there. Now that the cost base has been reduced, to get a better, for those cash flows coming from those higher potential things to flow down to the bottom line. So yes, in short, I'm looking to what management does at this stage and what the board does for what they're worth. Because as a reminder to the board, you are serving all shareholders in the company, and 61.3% of those, or yeah, it might have been 62.2% of those, sorry, are not the CEO. So you need to be considering them here as well. And that is your duty. That is what you're in place for. So in the unlikely circumstances that they are listening to this, please do your duty here and think and do what's in the best interest of all shareholders, even those unable to participate or unable or unwilling to participate in this equity raise. And yeah, we'll have to see. It's going to be resolved fairly quickly, because we know the deadline, basically when cash is going to run out, is going to be January, if they don't get these large contracts in. But it sounds like there's going to be a bit of a squeeze anyway. So yes, hopefully in the next couple of months, we'll see management will be able to give us a chance to really see them doing what's best for minority shareholders, and they'll have restored quite a bit of faith that their interests are aligned with us, and that they are doing what's in the best interests of shareholders as well as other stakeholders in the company. So anyway, yeah, I'm hoping we can have a reasonably positive outcome to these events. But yeah, let's draw a line under that and move on to what is some more positive news with ECOR resources. So another legal ruling, but one that actually worked out pretty favorably for the company in question, which is the 4 Mile royalty legal ruling, which they had held they were fighting against Quasar Resources. And the original favorable ruling, so this was actually an appeal, so this is why I said the formal legal ruling has been upheld. So the original favorable ruling on the 4 mile dispute has been upheld by the Court of Appeal in Australia, and the 9.3 million Australian dollar accrued can now be released to the income statement in Q4 2023. There is no impact on the group's cash balances, as this money has already been received. However, it does mean there's no longer a risk of it being returned to Quasar. So yeah, good news there. And it's not really going to help with their cash flows, but at least it means that money that they've set aside can now be released, and they can use it for other things without having to worry about the prospect of returning it to Quasar. If the dispute had gone, the legal ruling had been turned. I think that's the correct phrase. So moving on, that was just a brief bit of news for ECOR Resources there. Moving on to Warner Bros. Discovery, we have the news that Max is being included alongside Netflix in a $10 per month bundle being offered by Verizon. This will feature the ad-supported tiers of both apps, but still represents a considerable discount to standalone subscriptions. So the ad-supported ones are normally the cheaper option. But actually, from what I understand, Netflix has actually realized that their ad-supported tier has actually been one of the most profitable, because presumably they then make more per user on the ads than they were in the subscription, the difference in the subscription payments. So the ad-supported tier of Max usually costs $9.99, so basically the same price as this bundle. Though, as I mentioned a couple of weeks back, it was offered at a 70% discount for Black Friday. Upcoming releases. So in the next week, we will see the theatrical releases of both Wonka and Aquaman: The Lost Kingdom. Currently, the former is trending higher in terms of popularity. This was on IMDb, but we'll have to see how things play out following release. Something else that's just been released in collaboration with Amazon, and it's actually featured on Amazon Prime Video, is Merry Little Batman, an animated film with a Christmas theme targeted at family audiences. And as you can see, I think from this screenshot, if you're looking at it, or this thumbnail for the video, and you'll see, if you go have a look at the trailer or anything for it, that it's quite a unique, well, I wouldn't not necessarily unique, but it's quite an unusual and different art style for a DC animated. So it's very different to anything else as I've seen there. Much more like Nightmare Before Christmas, or all that, those kind of the Tim Burton ones and things like that. So yeah, it's that's quite interesting. I'm actually probably going to give that a watch tonight, so I'm looking forward to that. So yeah, that was there's also, we've got quite a slate of other new trailers. I think there was an event in Brazil which Warner Brothers was attending, and they released new trailers for that event for the House of the Dragon Season 2 coming out next year. I think that's next summer, maybe. True Detective Night Country, which is looking really quite good with Jodie Foster, and I think that has had a lot of views, the video I've seen on YouTube for that, the trailer. And that'll be, I think that's coming out in January. Had originally been intended to come out before the end of this year, but obviously the actors and writer strikes push that back, so they want to have a bit of time with using Jodie Foster to promote it. And then there was also a new trailer for the Penguin TV series, which is looking particularly good as well. A spin-off from the Matt Reeves Batman film. And that's coming out this year, and it sort of continues the story leading on, like it's like a week or something like that after the end of the first Batman film, and should set things up as we have the Joker later in the year. We've already had a trailer for that. And then the Joker is separate. I don't think it's the same universe or whatever. So there's the Matt Reeves Batman, but the Penguin obviously is a spin-off, as I said, and it sets things up for 2025, the second Batman film from Matt Reeves. So that's going to be a nice linear continuation there. And we've also had the Godzilla X Kong trailer, something like the New World Order or something like that, which is looking pretty like a pretty big blockbuster for next year as well on the slate. And we've had Mad Max sort of spin-off Furiosa, which is sort of like a prequel to the Mad Max Fury Road, focusing on Furiosa, who in that was played by Charlize Theron in the Mad Max Fury Road, and a younger version of the character has been played by Hannah something or other Joy. Sorry for not misremembering your name there. But yeah, she's famously played the lead character in The Queen's Gambit, the Netflix series about the female chess player, and also was in the Northman, and has been in several other high profile roles since that time. And yeah, that's looking really good. It's also got Chris Hemsworth in it, I think, in quite an interesting role. So yeah, that's actually on that same, when I referenced let me see if I can have a look here. When I referenced the trending list here on IMDb, this is actually the third, even though it's not currently in cinemas or anything, it's actually the third most popular movie on IMDb at the moment. So lots of people having a look at that one. And while we're here, I can show you that the currently Wonka is down in 18th place, and Aquaman is down in 37th place. So yeah, it's not a lot of hype at the moment, let's just say that, whereas Furiosa is looking particularly good. Anyway, let's go back. So yeah, right, I think that's pretty much everything for Warner Bros. Discovery. I'm sure I've forgotten some things that come out next year, but yeah, things are starting to move in motion. I think there's also one other thing was they got a Crisis on Infinite Earths animated film or something like that that's coming out soon as well, which I think is probably, I think that then fits within the new DC universe or whatever, sets things up for that James Gunn's new DC or whatever. So anyway, that's it for Warner Bros. Discovery. Let's move on to the final company we're going to discuss, which is Taylor Maritime Investments. So TMI has completed the sales of 2 vessels, one of which was announced in their prior trading update for gross proceeds of $16.8 million. Both were older and smaller vessels than the fleet average, So the sales will be lower. So the sales will lower the average age and raise the average capacity of the fleet. The proceeds of these sales will be used to repay $11.4 million of debt, bringing the outstanding debt balance for TMI down to $156.2 million. And on a look-through basis, with grind rod included, it's higher than this, but this is technically what TMI owes. Some other positive news is that after a small dip after the last trading update we received at the end of September, the Baltic Handysize index has now climbed up to a 1-year high of 872 as of 8th of December. So the chart that's shown below only shows up to the 7th of December, where it was 862, but it's climbed another 10 since then. Given that the Baltic Handysize Index time charter average was $10,214 per day at the end of September, I think this is adjusted for their average vessel size as well. Average Handysize vessels capacity. It's likely that the spot rates have now passed above the blended break-even point of $11,850. Now, this includes, and I've confirmed this includes debt payment, interest payments, and fixed payments, whatever, on the debt, and dividends. So, yeah, that's the level at which they cover all those things, and anything above that is then excess cash flow they can use to accelerate debt pay down, whatever other capital allocation stuff they want to do, special dividends, whatever, or new vessels, whatever. So yeah, we're back in positive cash flow territory, over and above the dividend, which, need to remind you, is a very healthy yield. So I think the share price is like it's under £1. Sorry, it's under $1 a share now. It's something like 90 cents, something like that, and the dividend is 8 cents or something. So yeah, you're getting close. You're getting close to the 10% mark at the moment. Let's just calculate that actually quickly. So let's say it's 63. Okay, actually, it could be even. We could be at the 10% mark. So 63 pence converted to dollars is around about $80. Just slightly under. So yeah, if we got 8 cents a share dividend, we could be at the 10% dividend yield mark. Not because the dividend has increased massively, though it is 1 cent a share higher than it was at the IPO. But we're actually now, but the share price has come down to such an extent that it's now going, instead of having a 7% yield at the IPO when it was $1 a share, we're now at over a 10% yield. So yeah, quite an attractive price potentially. But because it doesn't seem like things have recovered here. But anyway, yeah, so things are looking pretty positive there, and it's nice to see that they're not underwater. Hopefully they can lock in some longer term contracts now at these prices, and help to, or if the price keep on going higher, it does seem to be fairly vertical, this curve at the moment, than the one it's going to roll off. But yeah, it looks like they could be in a pretty strong position to lock in some longer term charters of 6 months, a year, or something like that, and and ride out any softness, and which is kind of inevitable in these kind of industries, to ride out any kind of softness we see in the future. So we already know that they've locked in a couple of $12,000 contracts, even when the spot price was down at 10,214. So Yeah, they're in a right now. You must be able to potentially lock in some charters at even higher levels. So yeah, all positive. I think for TMI, and yeah, I think that pretty much is going to do it for this episode. Yeah, you can check out all of the if you stumbling upon this video and you haven't already had a look at my newsletter, there'll be a link in the description. It's all free, everything like that. Go over to the website, firmreturns.com, have a look. There's you can look through these articles that I was describing, both of these here. Yeah. And I do also post on Twitter from time to time, so feel free to follow me over on there, and there'll be a link for that in the video description as well. But until next time, I will say goodbye and thank you for watching.